Today, CPI Numberwang jumps higher and still does not tell the truth. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, according to the ABS, in their data out today, headline inflation spiked to 3.5% in the year to December the 31st, 2021, which smashed market expectations, while underlying inflation hit 2.6%, and is now years ahead of the Reserve Bank's forecasts for where inflation is going to be. Households felt the greatest pain from price rises with non-discretionary inflation, which includes expenses such as food, petrol, housing and health costs, growing a 4.5% rise over the last year. Now, the markets had tipped around a 3.2% growth in headline inflation and 2.3% of underlying inflation. But on a quarterly basis, CPI rose 1.3% compared to the expectation of 1%. The annual price inflation of goods, which was up 4.3%, jumped past that of services, which was up just 2.3% in the December quarter, and that was the highest since 2008. The ABS attributed the results to global supply chain disruptions and shortages combined with rising freight costs, high demand, and also the fact that there was significant price increases across a wide range of goods, including dwelling construction materials, motor vehicles, furniture, and audio-visual goods. Now, the question is, of course, how many of these factors are temporary and might be expected to abate in the second half of 2020 if we can actually recover from the pandemic disruptions and if supply chains begin to heal. But at 2.6% annual growth of underlying inflation, or trimmed mean, is the RBA's preferred measure of price changes, and that's up 0.5 percentage points on the prior quarter and is now well within the central bank's 2 to 3% target band. Trimmed mean inflation is the highest since 2014, reflecting the broad-based nature of price increases, particularly for goods, the ABS said. The annual CPI inflation at 3.5% was driven higher by higher dwelling construction costs and automotive fuel prices. So we'll look at those in more detail in a second. Trimmed mean annual inflation, which excludes those price rises and falls, was still 2.6%, the highest since June 2014. And you've got to ask, how come you're ignoring the big items? Because, of course, the big items make the biggest difference. And growth in construction costs was partially attributed to the withdrawal of the home builder stimulus program, and a similar spike was seen in childcare costs last year after the withdrawal of temporary taxpayer support. The price of new dwellings, as well as petrol prices, were in fact the main drivers of the surprise result, with the former up 4.2% and the latter up 6.6% over the 3 months. High levels of building construction activity, combined with shortages of materials and labour, have contributed to 2 consecutive quarters of the largest rise in new dwelling prices since September 2000, which followed, by the way, the introduction of the GST. Fewer payments of government construction grants compared to the previous quarter also contributed to the rise this quarter. Those grants have the effect of reducing out-of-pocket expenses for new dwellings being purchased. Automotive fuel prices rose for the 6th consecutive quarter, resulting in the strongest annual rise since 1990. The automotive fuel series reached a record level in the December quarter due to higher global oil prices amid economic recovery and lower global supply. The national quarterly average price for unleaded petrol increased to $1.64 per litre in the December quarter. Now, according to the 2015 Household Expenditure Survey, on average, Australians spent approximately $2,300 on automotive fuel each year. That's probably understating because, of course, it's quite ancient history, really. That's reflected in the measurement of the CPI with a weight of 3.3% of the CPI basket. It's probably understated there too. Automotive fuel is one of the most volatile series measured in the CPI due to the aforementioned factors. This high level of volatility means that it is often a main contributor to the CPI headline movement. And this chart shows major international events significantly impacts Australian fuel prices and the magnitude of their impact on the CPI's automotive fuel series. And we also see the impact the price of fuel has on the headline CPI movement, which can be seen by the relationship between the annual movements of the two series. And then we can also look at how the automotive fuel series tracked over the past 5 decades. Across the 1980s, fuel prices increased at a faster rate compared to CPI inflation. During the 1990s, fuel prices were fairly stable before rising more quickly during the 2000s, and they reached a peak in 2008 just prior to the global financial crisis. Following the GFC, fuel prices were more volatile, with the 2008 peak only briefly being exceeded in 2014. But the new record level for the automotive fuel series was set in 2021. Across the 5 decades, the increase in fuel prices was 60% higher than the increase in the CPI, 1,597%, compared to 993%. Price rises in automotive fuel and new dwelling purchases were the main contributors to goods inflation in 2021. Prices also increased across a broad range of other goods, with strong demand and supply disruptions leading to price rises for goods such as furniture and motor vehicles. And rents for Sydney and Melbourne fell again in the December quarter. That's the 4th consecutive quarterly fall for Sydney and the 3rd consecutive quarterly fall for Melbourne. But rents across the other capital cities continue to rise, reflecting low vacancy rates in those cities. Rental prices for houses in Sydney and Melbourne have recovered more quickly than for other dwellings since the onset of COVID-19, and rental conditions for other dwellings remain subdued in Sydney and Melbourne. For the remaining capital cities, rents for houses and other dwellings have increased at a similar rate. Non-discretionary annual inflation is higher than the CPI and more than twice the rate of discretionary inflation. Non-discretionary inflation includes goods and services that households are less likely to reduce their consumption of, such as food, automotive fuel, housing, and health costs. And new dwelling purchases by owner-occupiers were up 4.2%, and they rose in all capital cities. Continuing strong demand for housing construction enabled builders to pass through increases in costs for both materials and labour. And ongoing supply constraints for materials and labour in some cities also contributed to rising prices. The largest price rise was recorded in Hobart, up 8.5%, followed by Adelaide, up 6.8%, and Brisbane, up 6.4%. Automotive fuel increased 6.6%, with strong rises seen across all capital cities during the quarter. Prices rose due to increased global demand for oil as a result of eased COVID-19 restrictions. The largest price rise was recorded in Hobart, up 12.4%, followed by Darwin, up 9.9%, and Perth, up 9.4%. And domestic holiday travel and accommodation was up 4.8%. That rose as border closures eased during the quarter, leading to increased demand for domestic airfares and accommodation. The largest price rises were recorded in Sydney, up 7.8%, Perth, up 5.3%, and Melbourne, up 4.1%. At the all groups level, the CPI rose in all 8 capital cities, ranging from 0.8% in Darwin to 2.2% in Hobart. Sydney was up 1.2%, where new dwelling purchases by owner-occupiers were up 3.4%, automotive fuel up 5.9%, domestic holiday and travel and accommodation was up 7.8%, and as a result, Sydney recorded an annual rise of 3.1%. Melbourne was up 1.1% over the quarter, with new dwellings purchased by owner-occupiers up 3.2%, automotive fuel was up 5.4%, other financial services up 2.1%. That was driven by real estate fees. And Melbourne therefore recorded an annual rise of 2.5%. Brisbane was up 1.6% over the quarter, with new dwelling purchases by owner-occupiers up 6.4%, automotive fuel up 6.3%, motor vehicles up 3.3%, and as a result, Brisbane recorded an annual rise of 4.3%. In Adelaide, it was up 1.5% over the quarter, with new dwelling purchases by owner-occupiers up 6.8%, automotive fuel up 8.3%, tobacco up 2.2%, and as a result, Adelaide recorded an annual rise of 3.3%. Over in Perth, it was up 1.4% over the quarter, with new dwellings purchased by owner-occupiers up 5.2%, automotive fuel up 9.4%, domestic holiday travel and accommodation up 5.3%, rents up 1.6% due to historically low vacancy rates, resulting in price rises, and so Perth recorded an annual rise of 5.7%. And Hobart was up 2.2% over the quarter, recording the largest rise of all capital cities. New dwelling purchase by owner-occupiers was up 8.5%, automotive fuel was up 12.4%, electricity was up 16% because prices returned to normal levels after the one-off $125 winter energy bill supplement for concession customers that was applied in the previous quarter. Rents were up 1.1%, and they rose due to historically low vacancy rates, resulting in price rises, and so Hobart recorded an annual rise of 4.5%. Up in Darwin, prices rose over the quarter 0.8%. Darwin recorded the smallest rise of all capital cities. Automotive fuel was up 9.9%, rents were up 3.1%, and they rose due to continued strong levels of demand and lower vacancy rates. Domestic holiday travel and accommodation, though, fell 20.3%, with domestic airfares decreasing for the wet off-peak season. Additionally, borders remained closed until late in the quarter. So Darwin recorded an annual rise of 6%. And Canberra was up just 1% over the quarter, with automotive fuels up 9.3%, new dwellings purchased by owner-occupiers up 3%, electricity was down 5.7% due to a one-off $200 rebate for concession customers, and so Canberra recorded an annual rise of 4%. Now, of course, last year, the RBA's Phil Lowe had strong comments about the fact that expectations of rate rises in 2022 were a complete overreaction to the inflation data at that time. But in its November statement on monetary policy, the RBA had forecast underlying inflation to remain at 2.25% until mid-2023. Economists believe the strong December quarter result will force a major rethink. Part of that is a growing view that the bank will need to end its $350 billion bond buying program at its February board meeting, and will have to move much earlier on lifting the current historic low 0.1% overnight cash rate target. And the RBA has previously advised its central scenario for the Australian economy would mean rates would remain on hold until at least late 2023 or early 2024. But what with the expectation of higher interest rates, particularly from the Fed in the US, and the higher inflation numbers, the RBA is completely off the scale in terms of understanding what's going on, it seems to me. But there's a bigger point here. The CPI, as reported, is a Numberwang, partly because the cost of housing is excluded. We have a rental proxy, and as I said earlier on, rents dropped in Sydney and Melbourne. Plus, we have some one-off adjustments. Now, the real interesting question is, if you were to go back and use the basis of calculation that was used prior to the RBA's removal of housing costs and some of the other changes that have been made in more recent times by the ABS, what would the true inflation number be then? Well, using a back of an envelope calculation, I think the true inflation number over the last year is closer to 6.8% averaged across all households. But there are some households where the number will be closer to 13%, particularly those less affluent, those with bigger mortgages, and those who are spending above average on travel and fuel and other discretionary expenses. So the takeout from this today is that even using the Numberwang answer, the RBA is off-key. But if you take a more real view of where real households are with their real expenses, then the costs of living are dramatically higher. That means, on one hand, the RBA has taken rates way too low for way too long, but it also explains the massive financial pressures that we're seeing on many households at the moment. One reason why our mortgage stress data is so high. And you may have noticed in my earlier mortgage stress discussion that the state with the highest level of mortgage stress is actually Tasmania. And it's interesting to me that Tasmania had the strongest CPI result. So I'm afraid to say that the CPI needs a major reboot and reset if it is to be interesting or useful. But in the meantime, the RBA needs a reboot and a reset because its monetary policy, its attitude toward inflation and interest rates are completely off the ball. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.